Welcome back. And we're now starting our last panel. I will introduce by name because you have the more details in the program. I have on my left Gabriel Bernardino, Luigi Lubelli, Nathalie Berger, Immo Querner, and Lionel Corre. But these are people who don't need any introduction anyway, I believe. And we're going to continue the discussion, maybe on a slightly less technical basis, but nevertheless covering similar ground. But I think that I would like to kick off the panel by asking each of the panelists their views on the key role of insurance, both for the role of the insurance industry for the customer, for businesses, and or possibly the economy. So, starting with Gabriel.
Well, very shortly, of course, insurers are there to protect customers, be it individuals or companies, are there to be the risk managers of our society, if you want it in one word.
So it's very difficult to improve on the definition. I mean, the essence is that, right? We protect the assets and the lives of people. We protect the well-being. I think another important feature which has become apparent during the meeting, we all know we are large investors, so we support the development and economic growth of society.
I would add two steps. The one which is that, of course, they are there to protect consumers, they're there to protect policyholders, businesses, I would say the current generation and the future generations. And I would also like to add that, in my view, they play a societal role, because society could not work properly if it were not for insurers to insure. Thank you.
Well, I couldn't agree more. I'd just like to add one, perhaps, additional observation in a kind of broader stakeholder concept. We should not forget that the ones who support our business, our role in the society, should also be thought of, and that means that they should require, our shareholders should require risk commensurate return on the funds that they have entrusted to us. So it's working both ways.
Yeah, good point.
I will go on more on Nathalie's definition. So the fact that insurance companies have to insure businesses, companies, and they have societal role. And I will add on the societal role, definitely as main institutional investors, they are one of the main fuels of our economies as investors. So, which for us policymakers is one of the key roles for insurance, apart from all the other societal role. And the first one is to insure.
Another question to set the scene for our later discussions, I think, is to what degree is important for insurers to continue to have long-term business and guarantees? And Nathalie, can I ask you to lead on that?
To lead on
the importance of insurers to continue to have long-term business and be able to offer guarantees.
Well, I would say that that's part of the definition, or that's the link with the definition or the next step. Remember that I mentioned protecting not only the current generation, but the future generations. And of course, being able to deliver on long-term liabilities. So it is, everything is linked. And generally, when you ask people about the difference in between banking and insurance, well, this is one of the first element which comes to mind, which is the nature or the time difference in the nature of the business. Short-term, long-term.
And I think, leading on from that, I think we've talked during the course of the day about many of the strengths of Solvency II, the fact that it's a world-class framework, and I think that point I think would be made. We also talked about the results of our survey, which confirmed some of the key benefits that everyone agreed that Solvency II had brought. But we've also talked a bit about some of the challenges. And Luigi, if I could ask you about, since implementing Solvency II, to what extent has Solvency II created challenges in terms of your product offerings and your investment decisions?
Thank you for the question. Actually, I think I was listening to Mrs. Berger's statement about, well, she was actually answering your question, but you were asking us about guarantees, right? I think it is true. It is our role in society to do so. Providing those guarantees has become more expensive of late. So that is something that certainly has changed with Solvency II. This morning, I think we've had, I must say, I must congratulate all the speakers who have preceded us today, because it's been actually very, very interesting. And I think we have set the stage for this conversation. I would like to add something, elaborating on what Immo just said. I think it is important to bear in mind that a big proportion of the capacity of the insurance market in Europe is provided by listed insurers. And so many of the elements that we're discussing today have a strong bearing when we go out there and speak to the market. So it has had an impact, yes. It has an impact because now there's considerable amount of capital that we have to set aside, not necessarily for reasons that we can derive. They did say it's a good initial approximation, but as Gabriel said, we have to refine it, because we are assuming assumptions that are possibly excessive. And other consequences come from the fact, as you pointed out in your speech, that we are assuming that we can transfer any their liabilities, and I've not seen that happening many times, or doesn't see that happening that frequently. So that, yes, is having an impact on our investments, is having an impact on our products, and it's something that I think should be part precisely of the discussions that we're having now and that were illustrated today.
And Gabriel, you've mentioned that you would be there's no sacred cows, and in terms of looking forward, what are you doing currently within EIOPA to take things further, and where do you think we could get to?
Well, as I mentioned, there's this request from the Commission, of course, on a lot of data in relation to the characteristic of liabilities, the investment profile, and the long-term guarantees, and how this, of course, unfolds at the end of the day. So we will build up to that request, but we believe that we needed to start earlier also on conceptual thinking in terms of the type of liabilities that we have, especially on the life insurance side. And that's what we started right now. So we started a work stream looking precisely at the type of life liabilities, the type of characteristics of these liabilities, and let's see where from there we will go in terms of the treatment of the assets that are backing these liabilities. And as I said, we are open if we find evidence that for different types of structure of illiquidity of liabilities, we can have different treatment because of the fact that insurers can withstand shocks of the short term without impacting their ability to continue to fulfill the liabilities. We will be open, of course, to have discussions and to find sound solutions for this. But if I just may come back to the point of the impact of Solvency II and not, I think we need to be also careful with one thing. There's no probably one true and one solution for this. There will always be different views on the risks that really you run in relation to the different types of products that you have out there. But there's one thing that we should not forget also. We had, of course, a lot of these guarantees in the past that were not priced correctly, and that's why we have a 16-year transition. And so I think it's good that we have this conversation in a sound way, because I believe that neither from the supervisory side, hopefully not also from the industry side, we want to come back to that situation. And I don't see it in that way. Now, to fine-tune, to understand how can we, of course, better have the balance there, fine, no problem. But let's also realize that the macroeconomic environment in which we are also has an impact in the type of liabilities and long-term promises that we generate. And we don't want, of course, from our side, to create in here incentives to, unsustainable business. No way. We have seen what that seems to, and so we should not go in that direction. But I think in between, the balance, of course, we are open to proceed and to find a better balance, if possible, at the end of the day.
I think that's reflected in the feedback we got, that Solvency II has improved risk management, asset liability management,
Yep.
all of those things, and I think that's accepted and agreed.
Yep.
And maybe, Immo, do you have any comments on potential barriers, though, that still remain, recognizing that improvements have also been achieved?
Well, coming back to the challenges, I think that's probably a good starting point. I think there are two types of challenges that we've seen when implementing Solvency II. Challenge of type number one is because reality has been challenging. Our products have been challenging, the capital market has been challenging, the guarantees have been challenging, our initial or ingoing ALM has been challenging, our concentration on certain issuers has been challenging, and that's probably still the case in some countries. So all these things need to be addressed. Second type of challenge, and while I'm a sort of big supporter, an ardent supporter of Solvency II, there are certain aspects, and that takes me to the second question, where it's not been reality or the necessity to adequately reflect reality has been the true challenge, but a kind of model overshooting or undershooting in some case. And I think I very much welcome the initiative now taken by EIOPA to look into the core feature of our insurance business that distinguishes us from the banking industry, and this is the availability or the privilege of sitting on illiquid assets that are not subject to a kind of free or call option of our clients, and thus that are not exposed to a kind of bank run risk. And if you ask a very simple question, is there a risk management difference between sitting on an illiquid liability or a liquid liability? It is obvious, and everyone would agree that there is, in reality, a big difference. Now, should this difference be reflected on the asset side? Probably not, because the assets, stocks, bonds, inflation risk, credit risk, all the same for us. They would have to be reflected on the liability side. And this is why I very much support the idea of some kind of illiquidity adjustment, as we know it under IFRS 17, for instance, so it's not a completely brand new idea. It's also been introduced, I think, back 10 years ago when we had one of the few sort of initial KISS studies. And I think the power of illiquidity is already recognized by EIOPA when signing off on the dynamic VA, for instance, when it comes to internal models. Now, when EIOPA is prepared to use the insights that you've gained on sort of when modeling interest rate risk, for instance, from the internal model users to sort of the broader stakeholdership, then you should not shy away to also export this kind of insight. And just one comment, the power of illiquidity does not stop at the last liquid point. Just as a side comment. Plus, the privilege of sitting on illiquid assets, or sitting on illiquid liabilities, must be reflected in the market value of these liabilities, whether or not you actually make use of this option. If you discount the liabilities and establish the time value of money of your liabilities, you do not ask the question whether or not your duration matched as far as the assets are concerned. You take the discount rate and apply it to the liability side. Very much the same should hold true for the determination of the fair market value of the illiquidity side. And then if you follow these principles, then I think there will be another reason to be a great fan not only of Solvency II, but also of EIOPA.
The devil is in the details, Immo, as you know it.
The devil is sometimes sort of hides in many sort of
Exactly, that's true.
holes.
Well, I think this is be food for thought for further discussion. But Lionel, do you see barriers existing in the current framework that could prevent insurers playing their full role, one could say, in long-term investment?
So this is one of the big questions to try to assess in which extent we have barriers or we have an effect, at least, on the prudential models. And as regulator, we have to take the responsibility of it and to try to figure out which responsibility we have. And the best thing to think is to look at the past, and in the past 10 years, we issued the first draft of Solvency II in 2009, which gives us a time framework on which we try to assess what happened in these years. And if we take the OECD figures, which is the best data that we have with long-term figures currently, we see that in Europe, by that time, in overall Europe, we lost something like 3 to 5 points in the allocation of insurance company regarding equities. And the question is what part is Solvency II and what part is linked to anything else? So what can we think? So EIOPA just issued a little survey, which but you didn't test the regulatory impact. In fact, it's difficult. But what we can see is what happens somewhere else, for instance, in the US, and we definitely did not have this kind of evolution at the same time. We can also see what happened in the different countries all over Europe. When in some countries we are around this average, but in France, for instance, it was even worse. Maybe why we were more sensitive about this issue, but it's something we see all over Europe, and this is definitely exactly at the right time that we had Solvency II. So maybe there are also a responsibility of the companies and supervisor, but the supervisor was applying or preparing a regulation we were putting forward. And at that time, when we were adjusting to Solvency II, and we had some insurance company, and the one especially were closer to the threshold. So the threshold used to be the SCR, and that was stated. In fact, the threshold went up, and the market is expecting up. So what is exactly the time when you need to adapt to the model? In fact, it went up. And what we've seen at that time, and it's a hint of something which happening, is that these insurers sold their assets. The one that did not have already sold their stocks long time ago, for instance, in the year 2000. We've seen a switch to unit-linked, which is currently a big trend, which also one hint that the cost of capital is becoming a driver for insurance company. And for 10 years, as a policymaker, as regulator, we've been struggling with our insurance company, and each time we want to drive more savings to financing the economy. We want to implement some measures. Everyone, the answer is the same. Well, I cannot because it's cost of capital. And this is a huge change. So definitely Solvency II has a role in, and we are still strong supporters of the framework and what have been said about the culture of the way risk is managed, assessed, the ways it has we say positive impact, even though we still have to work in order to fully measure it in the governance of company, in the supervision. But at the same time, it also has an implication on the activity. And one of the big issues, it was a question you raised before about the way to fulfill this long-term role in the economy. This is definitely a question that we had this morning. Do we have an impact in, for instance, on the long-term liabilities? And we think that we may have an issue. In life insurance, is development of unit links, which is a hint. On non-life, we have issues on long-term branches. And Gabriel, you mentioned in your speech the issue that we have with cross-border.
Yep.
And definitely we need to do something. But it's also a hint that on some long-term branches, there is an issue on the market, on our markets. It can be medical responsibility, civil responsibility. In France, we have construction, but this is an issue. And last but not least, for non-life insurance, most non-life insurance, and not speaking only about long-term branches, these are insurers that project themselves in the long term. And if we see, for instance, in most of the cases, they have twice the quantity of equity that we have on life insurance. It's so we need not to deter them to project themselves in the future. And in the end, the impact is on the other part of the balance sheet, on their investment. We need to be sure that we don't lose equities, and that we are able to have insurance company play their full role in our economy, and to be also competitive. And it's also normal that you have this, and we share also this belief.
Gabriel,
If I may very briefly, and again, I'm not saying that we couldn't see the insurance industry invest more in equities. That I think it could be possible, and let's look at this element of the liquidity, which I think it's relevant. But let's not also forget that in the current regime, when people talk about 39% risk charge for equities, in reality, that's not the case, because with the diversification effects, it's between 18 and 20%. So let's also talk about what is there in reality. And overall, as the numbers that we've got, since 2011, we don't see really a change in the behavior. On an average, there's some countries where there's some slight differences, but on average, the investment in equities continues to be basically the same. And on your point, and I think this is also something that very often, Lionel, comes to the discussion. I think we need to look at it. Why in the US you have more investment in equities than in Europe, and beyond, I think, a risk culture which is different in the different continents. Let's also not forget that we cannot compare Solvency II SCR with the risk-based capital requirement from the US, unless you want that we multiply by 3 or by 4, because in reality that's what happens. It is what they've got. It's an MCR basically, but in reality they work with 3-4 times the MCR. And so you will get at the end of the day, in terms of capital, you will get to similar positions. So we need to be careful with because in detail things are a little bit different.
I'm not sure I agree with this, in the sense your argument could be turned on its head, in the sense that and how much more would have we invested in equity had it not been for that? I think as I'm listening to you, I mean, I can only talk. It was interesting, Mr. Grund said today, I'd like to hear what the CFO thinks about this. Well, now it's a good moment to hear that. The fact is, you have to understand us, and we have to go out there, Immo and I for sure, of those sitting here, and explain this story to the market out there. I think all that you're saying are sensible. Certainly, what you were discussing were proposing in your speech, and what Immo just echoed about going towards a greater differentiation of liabilities according to their liquidity, and also a refined treatment of the assets. All sounds well. I just hope one day to have a system which, with its imperfections granted, reflects the way I do my business. My industry matches assets and liabilities. I don't know how we represent that and how we measure that, but that is my reality. And I have to live with a system which somehow denies that, which makes my life difficult. Mr. Grund was talking today about well, you keep 200, of course you keep 200% of solvency. You're right, I do. I keep 200% of solvency because I have a system which makes my reality possibly much more volatile than it should be in terms of it represents it in a way that is more volatile than it should be. If it were less volatile, then perhaps I could travel, let's say, 140, 150, whatever, a lower level. So, I mean, these things matter. I would like them to be kept in mind, because then it's all nice, this debate, but the fact that we have to hold more capital, the fact is that people don't necessarily understand why we do so. And that, of course, somehow we have to solve it. So, yes, we stop investing in certain assets, or perhaps we stop offering some guarantees. So, everything sounds fine, but please let's not forget that then we have to go out and explain this to the market. So I don't know if the equity is to remain stable, perhaps we would have had more equity had it been a different way.
But I think it sounds like one element of agreement is this need for capturing the liquidity somehow, the
Yes.
illiquidity rather, and I think that's
I think it's
and the
shared.
idea of matching and somehow that's not fully captured. And I think the issue may be more of a question of timing of when we can and should do that. But before we go maybe into a little bit of that, Nathalie, obviously we know that there's a lot of pressure as well from, and maybe this is a question for both Nathalie and Gabriel, there's a lot of discussion on making sure that companies have enough capital. Is there from a regulatory point of view, but also from a supervisory point of view, is there also a genuine concern that we don't overburden with too much capital?
Well, thank you, Olav. And if I may, I will go one step backwards and try to square the circle with your first question, because I think that's where the response is. And my response to the first question, the societal role of the insurer. And after the first question and the essence, the societal role of the insurer, there is the other contribution that insurers can give to society, and this is the one that we are also tackling via our action plan on Capital Markets Union. Due to the level of assets, we see them as major institutional investors who can contribute to long-term projects which will help restating growth in the European Union. Now, when we look into the measures that we can design in order to facilitate insurers' investments, we need to strike the right balance. And we need never to forget what is the prime objective of an insurance undertaking, which is to insure and to protect. So, of course, we're looking into this. And of course, we do want insurers to be able, notably in the current low interest rate context, environment, to be able to search for investments which will bring a higher yield. And you can see that we have already taken some measures. We have adopted some recalibrations regarding insurers' investments in infrastructure projects, in infrastructure corporates. We have also incentivized investments in LTIFs, and we have just adopted something regarding STS securitization. And we will do more. However, when we do something, we need to do it on the basis of solid data. And this is the reason why, regarding, for example, equity, we have commissioned a study to get some more information on the drivers of insurers and pension funds investments in equity. So, in equity, to come back to equity, we can hear, different voices. We have EIOPA's report on equity, which gives us data as to the fact that despite the application of Solvency II, there have still been insurers' investment in equity. And there is one element which is important to mention, which is also the element of culture. Cultural behavior, and why is it that an American insurer would invest more in equity than a European insurer? Of course, the easy response may be at first sight the calibration of the shock. But there may be other elements which will contribute to this, and we would maybe need to look into more detail as to how the logic of the calibration is done. So, yes, insurers need to hold capital. The question is, what is the right level of capital? And we have started in the framework of Solvency II with some assumptions based on facts and based on data. And we are also willing to examine, to look whether the standard formula is fit for purpose and whether it is adequately balanced. For that, we need to have the data and to always keep in mind the prudential element. And if comes a moment where we have to take an arbitrage in between, pushing a calibration downwards and pushing it slightly less downwards because we want the system to be safe. It is in the interest not only of policyholders, which are the first objective of Solvency II, but it is also in the interest of insurers, European insurers, that we look well at the prudential aspects. And this is extremely important because another of our objectives is to defend the position of European insurers on a global basis, on a worldwide basis. And there are two components in there. One, of course, is the professionalism, the know-how, the expertise, the experience, the quality of the services provided by the insurers. The second one is, or I don't know if it's not the first one, or it's part of the two, the binom of elements, and this is the fact that Solvency II is the world leader in terms of prudential requirements, and that investors in third countries and partners in third countries, they take European insurers extremely seriously because they know that the prudential regulation is sound. So it is all an element, a matter of finding the right balance. And we're happy to look again at where is the right balance, or where should it be.
I think Nathalie said it, everything, it's clear for us in terms of our mandate that we are there to, of course, have the privilege of the protection of policyholders. Second mandate in terms of the stability of the market. But of course, in a regime like Solvency II, where you have a definition ab initio of a level of security from a capital perspective, that's what we, of course, try to deliver. And that's why the evidence and having facts to support the calibration, it's really important because that's what I think at the end of the day brings also the credibility of the regime. And we should all try to, to align to that. And you know my view and our view, I think generally in the supervisory community, that of course, if we have evidence in terms of a treatment of a certain risk, I think we are, and we proved in the past with infrastructure, for example, that we bring in solutions. If it is leaps of faith, then it's not for supervisors to take. That's legitimate political decisions, but that's not up to us. Our mandate is clearly on making sure that the regime is fit for purpose in terms of policyholder protection.
But if I may, let's differentiate between being prudential and overkill, in the sense that I don't think that we are saying anything different from what you are saying. Well, what we are saying is that the economic reality of the business has to be analyzed, and if the capital requirement, there is a capital requirement, there will be. What you have to appreciate is the fact that if that capital requirement is excessive, that protection, I'm fine, I agree with you. Of course I care about my policyholders, but I also care about my shareholders. And the fact that I have an availability of shareholders out there, that's my problem. Immo, would you like to?
I think there are two important things that we should distinguish. Wrong calibration, whether it's in internal models or standard model, may create two problems. A too high capital requirement, which in the end means an under provision of society with insurance, because insurance is too costly and shareholders would not be prepared to back that up. Second, and this is in many cases probably even the greater of the two problems, relative mispricing of different levels of activity. And if sort of all this talking about sort of supporting sort of investments here in A and B, I don't know whether I really like it, because I don't want to be pushed around to invest in politically desirable assets. It all sounds a bit like financial repression, which I think is the wrong way forward. All I'm asking for is that the true riskiness of our activities should be properly assessed, whilst accepting the privilege of the nature of our liabilities. And now, at the risk of being a bit technical, sort of, if you look into the VA as it is used by the internal model users, although this is an imperfect approximation of probably the true illiquidity spread that we should benefit from. There's a high correlation of around 50% with, I think, the prices of equities. So in as much as you allow for dynamic VA, you automatically get the capacity to also hold more equity, not because you want to push people into holding equities. It is just the natural result of applying sound mathematics and economics to the problem. And this is what we want. Nothing more, nothing less. And all elements of distorting economic reality into the wrong direction, that is politically desirable, is something I'm very skeptical.
Totally agree with that, Immo, but that works both ways.
Yeah.
Because of course, if you also undervalue and underprice a certain type of risk, then you have the same behavior, and then we create bubbles, and then we all. So
I agree.
I think what we're trying is to see where, of course, the middle point solution and the closest way that we can get to the right risk behavior. And maybe you think that we are overshooting. Maybe we think that we're not overshooting. That's for sure. But the channels are open there to analyze this and to go deeper, because I think we all accept that we should not have neither overshooting, neither undershooting, which happened also in the past.
I think that's right, and I think we always refer to the fact that the industry position is not to ask for incentives. We don't like the use of the word incentives because it implies that we want some assets to be artificially lowered, sort of SME halving just to encourage. I think what we've always been asking for is exactly what Immo said, is the right analysis of the risks based on the reality for insurers, which of course may not be the same realities for traders or bankers or other people, and it's really taking the insurance view.
Depending on the liability.
There is something else we should at least think of, and this is the power of Pillar 3, at least for the listed companies. I mean, our investors would not only look at the amount of capital that we hold against the amount of risk that we have, and whether it's a 200 or 180 or 220% solvency ratio. I think they would also look at the sensitivities.
Exactly.
Now, if you're sitting on an insurance business that is highly susceptible to market shocks, people would automatically translate this into a higher beta of your stock. And this is not necessarily what we want. And you've recently seen sort of a very prominent example in the industry going for more technical risk and lowering the implicit beta in order to lower the cost of equity. Now, even if we had the opportunity to invest on underpriced, solvency-wise, underpriced asset risks, I think there would also be the sort of someone else looking at the sort of watching over our shoulders in the background, at least for the ones who are listed, that the beta doesn't grow too much. Now, I see that you nod. I like this because accepting the fact that insurance, essentially pure insurance, is a low beta business should then be reflected by the cost of equity in your risk margin calculations.
I think we'll come on probably back to that topic in a moment. But Lionel, I think we've talked about the path to improving is taking full advantage of the two reviews coming up, and I think it's worth looking at the relative sort of priorities and the timing of those improvements. Lionel, would you maybe share your views on maybe what can and should be done now under the 2018 review?
Okay, thank you. Definitely the equity issue. Why? Well, first of all, for instance, I was reading the newspaper yesterday in France. We had there was a big title about how the Israeli startups was managing to, so it was in cybersecurity, which is one field or another, to get last year 800 million euros investment, and they had in their studies 400 startups, and there was comparison with France. So we get 600 startups, which is better, and they raised 26 million, which is less encouraging. and if we see more globally on the startups issue, France is not the worst ecosystem in Europe. And what we see on the startups issue is not that better in other fields. And if we see where this money, I have been a diplomat in Israel for a few years, so I know this ecosystem and where the money comes from, a lot from abroad. And we're not that bad in Europe to get financing from abroad. In terms of direct foreign investment, we are very competitive. We even have the reverse problem that the equity of many, even our big firms, are. We don't have figures of last year, but the part, if we compare to the US, even if we always have to be careful with comparisons, is globally twice, which shows that we may have issues of attractiveness, but we are still attractive. So we may have an issue of the availability of capital, and it's maybe even stronger on more traditional businesses than startups, which are definitely less attractive for people coming from far away. The availability of capital locally in all markets, listed or unlisted, is just absolutely key for all kinds of companies, and especially small, medium, intermediate companies, traditional business or startups. So definitely there is an issue. There is an issue now in Europe. We are trying to tackle that with the Capital Markets Union. It's we are strongly, as for France and most countries in Europe, strongly pushing that. But the question is now, and this issue is now. And if we come back to Solvency II, is the impact of 2, 3, 4, 10 points? We don't know. What we know is that we had an impact, and for the US, I was not comparing the stock. I would not even try to do that. Just seeing just the evolution in the last 6 years, which leads us to think that there is an issue. And one of the issues is we made some other tests. For instance, we had some insurers in France that developed a model to calculate their target allocation for assets. And they tried to, one of the parameters would be to try to do Solvency I to do Solvency II. And the effect is immediate, 5 points. So this is a model, this is a company, but this is once again the same kind of figures. And 5 points, of at least 3 points of equities in our economy is just a huge impact at a time when we think we need it. And definitely we have an issue, and this question was raised this morning about the way the model is tackling the long-term business of insurance company. So we have some adjusters that don't work, but definitely the model and the model has this consistency, and we are supporting this consistency. But definitely for these equity that are not used for trading purpose, definitely most of the time at least, the model is not showing that. And which come back when Gabriel, you talked about liquidity. Yes, maybe we can work on liquidity, but I would put it another way. If the company is able, on a liquidity shock, to be able not to sell their stocks, which is most of the case, and when we have only 13% of equities in our balance sheet, definitely we have a huge shock in order to be at the stage when companies need to sell their equities. And when I said 13, it's an average, and in some of our countries, as you know, it's far lower than this. We have an issue, and this is what our proposal with our Dutch colleagues to tackle in this review in 2018, because first, once again, the time we're losing, it's time we're losing for our economy, and we will have a review in 2020. I will have lots of questions for 2020, and many issues about the long-term business in 2020. But the issue is now. The issue is now, and the calibration is something which is under review. This is the review that we have. So this question was not asked to EIOPA, and you're in your role to say, just be careful what you're doing. we have to be prudent. I was a supervisor at the beginning of my career, so I fully understand that. But it's also our role, the government, to push this question about the equity. We know we have something in the model we have to tackle. We will not change the model. In fact, we will not ask to change the model in 2020. But because we can work on the calibration this year, so we need to do this year. And of course, to put the right framework and this liquidity issue is in our mind also the right mindset, but as a broad aspect of the once again to just have the model being more consistent with the long-term business model of insurance, and we're not saying anything other than that.
Well, I think the survey we did, when we did ask about the improvements made, I mentioned that earlier on in my presentation, there was, I think, we asked the question of whether that would, with a change in the equity calibration, would increase allocations of equity, and 40% answered yes, which was a similar number to commented that the changes in the infrastructure would have a positive effect. So I think there is a feedback from the market that there could have an effect. But maybe, Luigi, are there any other priorities that you would add to the 2018 review?
Well, I think the 2018 review, it was once again the part of coming at this part of the day, we discussed so many issues already. I think it's pretty evident that two of them, the most prominent to me now today after the conversation, is clearly the cost of capital and the LAC-DT. They clearly are issues. I've heard many things today about the cost of capital. I think once again it falls within the same kind of reasoning, which I see a fil rouge that's keeping together all the aspects that we are saying today. The question is not, is it X, is it Y? How is it arrived at? Let's make sure it is arrived at in a way that we all understand and share. So that is, as the industry, I imagine I'm speaking to colleagues on here and in front of me. So you know that the industry through Insurance Europe, CRO Forum, CFO Forum has made observations about how we think the cost of capital should be arrived at, and we have disagreements. Otherwise, it wouldn't be fun talking to you from time to time. Come on. And so so I think that I mean, also in terms of there are elements there which we think warrant a level which is lower, and provided whatever level it is, people can reconstruct it from a logical standpoint and arrive at that. I think that is fine. It's like the calibrations. I don't know if the calibration of an equity has to be 5% of 75%. The important thing is I follow a process and I understand. Well, I'd rather not be 75. But the important thing is I get to why and from what perspective is that. Same for the cost of capital. I was listening to you on taxes. Actually, it's been a conversation that we were having before at lunch. I would say the lunch break was very fruitful. And as you know, the question is there, if you take it from a point in which, and I subscribe to that. I think something I like very much in your speech is that we have to have consistency in approach. The more you have it, the better it is. I don't think there's anybody in this room who's going to deny that. Whether on this one it has to lead to the same outcome, I am skeptical. In the sense that to the extent that I do not have the same tax rate and the same tax regime in every country, it is one of those cases in which it would seem to me objective to have different outcomes, arrived at in following the same process, agreed. So that is something I beg to disagree on. But I would think these two, in my view, are topical at this moment.
But if I may, just Luigi, without going into the debate, the issue of LAC-DT, and we published the numbers. It's quite clear. There's 100 billion of LAC-DT out there close by. 75% of these is taken by the differences in the fiscal regimes, and so that we we park that. We don't touch on that. So that's taken. But the other 25, which are quite relevant, of course, and make a lot of an unlevel playing field throughout Europe, has nothing to do with the local tax systems. It's especially about the projection of the future profits. And that has nothing to do with the tax regime. And that's where the differences were, and that's where we bring the proposals to have much more consistent treatment. So to be very clear on that.
And I think that, I mean, I just say that, but I think the feedback you've got from the industry is that there's no pushback against having the consistency in the principle-based approach and making the principle-based approach more sort of rigorous or applied. I think the issue is where you've introduced a hard limit, which, irrespective of the amount of evidence.
That's rather the point.
And I
but
think
there's
that's the issue.
But there are elements, as you know, also to have a flexible approach to that. If you provide, sufficient explanation, if supervisors are, of course, conducive to accept that due to the type of business, etc. So, I believe that this was probably the area that was more difficult, of course, to find an agreement at our board. Those gentlemen then know, but I think we have found a very good outcome. And really, when we have evidence of issues that are materially divergent in terms of implementation, we need to have the courage to tackle them. That's for the benefit of the implementation of the regime throughout Europe, and of course it can be debated and discussed. But I think that this was a fundamental issue there.
I think that we're getting towards the end of the time, but I would like to ask a question to you, Nathalie, and that's over the overall timing, because I think there's the 2018 review was launched with a call for advice in 2016, so I think 2.5 years before the deadline. I think there's some question about whether when would the similar process, and obviously you started it to some extent with the call for information, but when do you envisage the process for maybe a call for advice, and will there be enough time to complete the work by the end of 2020?
Yes, thank you, Olaf. We are looking into the Solvency II review, the SCR review and the 2020 review, if I may say, in a holistic approach. Everything is linked. And we're trying to get a smooth sequencing of the work and of the review. So, as you rightly mentioned it, we have sent to EIOPA a call for information to, if I may say, prepare the ground for our work, or the ground for our future work. But we are intending, of course, to send EIOPA a call for formal advice. And if everything works as planned, our intention is to complete the SCR review towards the end of this year, and immediately afterwards, or at the same time, or more or less in a subsequent manner, to send the call for the call for advice to EIOPA, either before the end of this year or at the beginning of next year, so that we give EIOPA sufficient time for EIOPA to respond to this call for advice, and so that we have sufficient time afterwards also, of course, to work on the basis of solid evidence, solid advice.
Immo, do you want to answer?
I think you've made a very important observation, and this is everything is linked. If you accept this notion, I think separating the model change process in internal model language into two steps, the 2018 sort of campaign and the 2020 campaign, is questionable. Because if everything is linked, then we should shoot for a comprehensively consistent set of changes. What we don't like is the kind of piecemeal approach. What we don't like is a regulatory environment in which the volatility of the regulation is at least as high as the volatility of reality. That is a killer to us, to our shareholders. And I'd really urge you to take your resources to carefully prepare the grand revision, and not make our lives more difficult in between, for instance, the LAC-DT issue, but always look at a kind of holistic picture. If there is one element where I'd say this is something you could and should do, is to initiate a process of somehow lowering the cost of equity for the risk margin calculation. You haven't turned a blind eye to the development of the capital market when as far as the UFR is concerned. So you shouldn't turn a blind eye to market reality and to economic reality when it comes to the cost of equity. And the rest should in my eyes, be taken in conjunction, particularly with a more educated, more realistic, more appropriate modeling of our liabilities. Because many of the issues that we discuss are deeply related to this very fundamental issue.
Yes, may I? You're making a very, very relevant observations, Immo. If I may say, the Commission is kind of supposed to follow the decisions of the legislator. And the legislator, when giving its consent to the delegated act, the implementing measures in 2014, requested the Commission to do the SCR review in 2018. And it is just normal that we follow the will, we follow the decision of the legislator, and we articulate our work as the legislator has decided that the work should be articulated. This being said, of course, we are looking at everything in a holistic manner, and when we decide of the work on the SCR review, we always keep in our back head or in the back of our mind what we will want to do or what we will want to be prepared or in a position to do in the context of the 2020 review. And regarding equity, you can see, there is a very strong signal. We have engaged the citizens' money in a study on equity. So we are going to do some adaptations regarding the calibration of investments in unlisted equity. So that's already a first, a first side or a first part regarding the treatment of equity. We're also looking into privately placed debt. And we are examining, and I guess that many in the room will be contacted by our consultant to ask and to get some information precisely on the drivers of insurers' investments in equity. So everything is started, you see. We don't, first of all, only focus on SCR, get SCR behind our shoulders, and then turn to 2020. Everything is organized in a round manner.
Additional comment, because your question, in a way, although this is not for me to criticize you, was kind of biased questions. What should EIOPA do? Sometimes it is also good to ask the question, is there anything they shouldn't do?
Sorry, that's not the question.
And sort of preempting sort of this question, I think, and that comes back to some of the comments that we've seen, particularly if we want to support a capital market union or greater sort of convergence of the economies, that we should not start to further nationalize any calculation or components of the way how we calculate own funds or risks. That, in my eyes, would be exactly 180 degrees off track.
If I may, just one small thing. I totally agree with the issue of course, having clarity about what are the changes. And that's why, from our side, we really want, in the second half of this year, to have clearly a roadmap of what are the elements that we're going to work on. We not talked about, for example, one important element that we want also to take a look in the review, which is about reporting and disclosure, because that's also an element which is relevant in the regime. So we need to have clarity about that in order to avoid that kind of perception that everything is at stake at all the time. I think we need to have clarity on what we are targeting.
Then we'll move on to some
reporting and disclosure. Something that you said about stability of regulation. An issue I have to bring. The long-term guarantees are something that are going to be reviewed as part of the process. The fact that I think we have a problem, I've said it many times, even in conversations with you over the phone or other occasions. The fact that, for instance, we do stress test with or without the long-term guarantees that we report. I know it's a parliamentary request. I know it came in law from the parliament, but it makes it look like it's a movable part of the regulation. So it is damaging in the perception of the industry on the market, the fact that, because as you take it from the side of common people, of investors, people who look at this, they say, well, as the transitionals go, well, perhaps the LTGs will go. So I think if that could be clarified, that would be beneficial. And in terms of disclosure, certainly I wonder what you're going to touch now, but certainly there's a matter of how onerous it is. And to this morning, there was a very interesting discussion about this FCR and the usage of this FCR. Couldn't agree more with you, Mr. Grund. I don't think any policyholder reads my FCR.
I don't agree.
I mean, if all the policyholders, are PhDs, I mean, it's not our problem. But
We will have that conversation, that's for sure.
but I don't think it's as read, so it could be simplified possibly.
Yeah.
Yeah.
I think no, I think it's a very good point that it's not just around the long-term measures. There are other
Yes.
issues, including proportionality,
Yeah.
and we mentioned that this morning, that need to be
Yes.
looked at and are being looked at. We very much appreciate that. But I think before we wrap up, I just want to check if there's any questions from the audience. Yeah. Do we have a microphone, I think? Yeah.
Yeah, thank you. Mireille Aubry from Korea. I would like to take the opportunity, rather than asking a question, trying to contribute slightly to the debate on the influence Solvency II might have had on the equity asset allocation. And I'm referring to the qualification of equity holdings. Sometimes equity holdings are considered as participations. And in Solvency II today, if they are participations, they already benefit from a reduced shock. And as a matter of fact, the representatives you have this morning in your panel, both Germany and Italy, are actually countries where equities are almost massively qualified as participations in Solvency II. So we would then not be surprised that in those countries there hasn't been such a tremendous impact in the equity allocation.
Okay. I think that there was more of a comment. Any feedback on that? very quick. If we can be quick.
If we have a risk-based regime, I don't understand why participations have a different risk treatment than normal equity, but that's a different thing.
The answer, there is, I think, in my eyes, a very simple explanation. If you look at solo companies and they hold other insurance undertakings, then of course these are participations.
Yes.
If you look at the consolidated balance sheets, I think
that's
the
a different
amount of the composition of the equity would be quite different. It is just a matter of fact that the overall exposure of German insurance companies to listed equity has always been relatively small and is still very small. Yeah.
No.
So this is, I think it's not a kind of very tricky regulatory arbitrage around bond that has led to the situation.
EIOPA is now publishing consolidated figures coming from the balance sheets, and we have the Q3, Q4, 26 and 2016 and 2017, and based on 2016, Germany had at solo level 36% in equity participations, and I guess that was in solo level and group level. The consolidated Europe is 22%, and at group level it's 15%. So we're losing, and among these 15 is half our participation. So I think we have on average 50% coming from intragroup. So you still have 18% in Germany without intragroup, and that's external participations, and that's because you have more medium-sized firms, and for the same ticket you acquire a participation, whereas if you invest in multinational, you do not have this stake of participation.
Okay, well, I think on that one we will continue. You can continue the discussion over the afterwards. But I think we have one question over there, and I think we would have time just for only one more after that.
Thank you. Yeah, just two very brief questions. The first of all is a clarification regarding the 2020 review. because the call for information is supposed to end at the end of 2019, but I have understood that the call for advice is going to start early. So is there going to be a moment in which the call for information and the call for advice are going to be launched out or running at the same time? This is the first question. The second question is more general, is many of you have agreed on having an amendment on the evaluation of liability that it is reflecting better the liquidity of liability. My question is, what would be the changes in terms of the measures that we have now that you have in mind regarding this 2020 review to reflect this illiquidity? Which amendments should be introduced in the system to reflect this illiquidity in the 2020 review? Thank you.
Thank you for your question. Well, indeed, there will be a sequence of work and requests to EIOPA. So we have already sent the call for information, and we're of course following the work within EIOPA and the work of the committees, etc., internally, which helps us in itself to prepare for the call for advice. So at some stage, EIOPA will be kept busy in this topic by two calls running in parallel. Yes, that's correct.
Okay, I think we have actually running out of time now because we've got to move on. So I'm afraid I think we're going to have to stop there, sorry, because of the time. But I think thank you all for the audience listening. Thank you very much for to the panel for their contributions. So I think we should give them a round of applause. Thank you. Thank you.